Welcome to Introduction to Balance Sheets, the second or third video in this lecture series on financial communication. This video will cover a brief review of the income statement and profitability and how that leads into the balance sheet, the purpose of the balance sheet, and then elements of the balance sheet. A company's profit is its net income. In other words, revenue minus expenses, which is found on the income statement. But as we talked about in the previous video, profitability, though, is how well resources are used to generate that profit, or i.e. the ability to earn a profit. To measure profitability, the resources employed must be examined. These can be found on the balance sheet. The purpose of the balance sheet. The balance sheet reflects the status of an operation's assets and liabilities and owner's equity at a certain point in time. Remember, catch that point in time, which is different from the income statement that covers a period of time. So what we mean by that is the income statement, it might represent everything that happened throughout the year, where this point in time on the balance sheet indicates, for example, that you had so much inventory on this date. Doesn't indicate how much inventory you had prior to that, how much you had over the year. On this date, you had this much inventory. We talked about accounting being the official language of business. And when we talk about that, we said that the income statement tells the story, but here we'll say the balance sheet sets the scene. The balance sheet provides information about the financial health of the company and its ability to use its resources to satisfy claims against those resources. The simple accounting formula that everybody remembers if you've ever had an accounting class is assets equal liabilities plus shareholders' equity. We will use this sample balance sheet right here to discuss the elements of the balance sheet. Elements of the balance sheet. Again, remember our formula. Total assets equals liability plus shareholders' equity. So in essence, what that is saying is that the total asset number here will equal total liabilities plus total stockholders' equity. In fact, total assets will always equal total liabilities plus total shareholders' equity, or stockholders' equity, or sometimes simply equity. Owner's equity, maybe even. The reasons are simple. One, it's a basic accounting rule, and I'm actually convinced from studying accounting that it's probably the very basis of accounting. Like it was the formula that the whole profession of accounting was based off of. Secondly, from an operator standpoint, what we need to recognize is what it means from that standpoint. That all assets of an entity are funded with either a liability or equity or some combination. Here's what I mean by that. So it's never okay for a manager to say that, for example, they might have a truck or forklift that they never use, and then to say, well, it's okay because it's paid off. What they in essence are saying when they say that is that there are no liabilities against that asset. But if you think about it from that perspective, that means it's 100% shareholder money that's tied up into that piece of equipment that is not being utilized. So from an operator standpoint, what we have to operate in or think like was we have to think that everything that we have has a liability against it, because it does. It's either a creditor's money that we've borrowed to buy it, or it is the shareholders' money that's in that, and they're going to expect a return on that money. The unit of measure informs the reader as to the size of the numbers. So for example, you can see here it's kind of small, but you can see all numbers in thousands. So what that means, for example, is that the cash and equivalents, where it says 29, looks like 29,484, actually represents 29,484,000 rounded. The date, represented here, represents the date of these values. And again, it's a point in time. So this is the amount of these assets, liabilities, or stockholders' equity on that date or at the end of that day, actually. And remember, that's different from the income statement that covers a period of time. The first section of the balance sheet that we'll discuss is the current assets section. Current assets are assets that are expected to be converted into cash within one period. Typically, we're talking about 1 year. The order of the current assets has some significance here. They are listed in the order in which they are expected to be converted into cash. Some might call that in the order of liquidity. In other words, cash and cash equivalents is obviously quicker to turn into cash, since it already is, than inventory is. So that's it's important the way it's listed there. The first current asset listed is cash and cash equivalents. You see it here. This amount represents the amount of currency and demand deposits, as well as short-term, highly liquid investments held by the company on that represented date. Accounts receivable. Accounts receivable is the money customers owe the business for products or services that we've sold that they have not paid for. They've bought it on credit, we've extended them credit terms, and that allows them some time to pay for it. Accounts receivable net is that money minus an estimation of bad debt. So if we have an estimation of it, if you see net, typically it's net of something. Something's been minused out of it. Accounts receivable is typically one of the two largest assets on most distributors' books. Used to always be behind inventory, but we see it's quite common today for accounts receivable to actually be more than inventory. The inventory number we find on a distributor's financials is the inventory available at book value on the given day. What we mean by book value, it's the value it is on the book. So typically it represents what was paid for the items, but not necessarily what today's market value is. There may be some differences due to one reason would be due to rising prices of materials and inventory. Another could be based on how you do your costing for inventory, such as FIFO, LIFO, or average cost. And again, as mentioned when we were talking about accounts receivable, inventory is one of the two largest assets on most distributors' financials. Another thing about inventory that we got to pay attention to, one, it is a major asset, but also it is a major expectation from the supply chain that the distributor be really good at managing inventory. Prepaid expenses are expenses such as rent that has been paid in advance. Other current assets are assets that are expected to be converted into cash within one period that do not fit into one of the other categories we previously discussed. Typically, you see this a lot in financials where there's different various categories of items, but typically each one of them is not enough to line item on the financials, so it's just everything's kind of lumped into that category. Listed below current assets, you have what we refer to as our non-current assets or long-term assets. Basically assets that are not expected to be converted into cash within a given period. The first listed here is property, plant, and equipment. Property, plant, and equipment generally consist of land, buildings, and other capital expenditures that have a life of greater than 1 year. And if it says net, typically that's minus a deduction for depreciation. Goodwill generally consists of amount paid for an asset above the fair market value of the asset. When we get to valuation, you'll learn that the valuation video, you'll learn that oftentimes we're buying a cash flow when we buy, say, another business, for example. And if you add up the value of all their assets at what they could sell the individual assets for, it may total less than what we actually pay for the business. And the reason is because we're buying the business. Some people refer to that as blue sky. You bought something and it was $1 million worth of product plus $500,000 in blue sky. What that basically is goodwill. That's how you record it. This is the amount you paid above the fair market value of each of the components. Intangible assets Intangible assets are assets of a non-physical form that are amortized over the estimated life of the asset. Examples include patents, trademarks, contracts. Maybe you bought a customer list to have access to certain types of customers. Those would be intangible assets. When you think about tangible versus intangible, you can't touch it, you can't feel it as much as tangible assets that you can touch and feel. And other assets listed here, again, are assets that are not expected to be converted into cash within the period, that do not fit into one of the other categories. Liabilities found here. Liabilities are claims against the assets. More commonly, liabilities are recognized as debt of the company. Current liabilities are liabilities that are expected to consume cash within one period. So think about, we talked about current assets. Current assets are expected to be converted into cash. Current liabilities are expected to consume cash. And so if you think about it, you want to really be able to compare these two, and a risk factor would be to analyze and make sure your current assets are larger than your current liabilities. Accounts payable. Accounts payable is the money owed to suppliers for products and or services. Suppliers that offered us credit terms, we buy the product but we haven't paid for it yet. That goes into accounts payable. When we pay for it, it will then come out of accounts payable. This is typically one of the largest liabilities for a typical distributor. It is a best practice to manage accounts payables optimally, since this is the distributor's only interest-free debt. Using suppliers that provide better payment terms allows distributors to better manage their payables. One of the factors that helps suppliers in the distributor's mind achieve top-tier status is about offering preferred payment terms. So maybe extended dating where you can pay for the product even later. Again, this is the only interest-free debt you typically have in a business, and it's not provided by your creditors and not provided by your provided by your lenders and not provided by your equity shareholders. It's kind of it's a thing in the business where the reason suppliers do it is they're helping fund the movement of the product through the supply chain. And they want to encourage distributors to have more inventory in the local markets. Accrued expenses are expenses incurred and recognized but not yet paid. So for example, you might have a landlord that let you wait 3 months before paying that first month. So you'd have to pay all 3 months at the end of 3 months. You wouldn't have to pay it up front. From an accounting standpoint, we would still recognize the rent expense in that month even though you haven't paid it yet. So that would be an example of accrued expenses. Taxes payable. Taxes payable is the tax expense incurred and recognized but not yet paid. So we've recognized the expense on the income statement, but we haven't actually paid the cash. The timing of when taxes are paid and what is considered a taxable event by accounting standards are not always the same. Ultimately, the taxes incurred and recognized and the amount paid will equal out, but the timing can vary, resulting in us showing that we owe taxes still that we've recognized, but the IRS hasn't made us pay it yet, so it becomes taxes payable. The current portion of debt is the portion of the long-term debt that will consume cash within one period or within a year. Other current liabilities are liabilities that are expected to consume cash within the period that do not fit into one of the other current liability sections we discussed. Long-term debt. Long-term debt consists of obligations of the business that is not expected to consume cash within the period. Examples include bonds, bank loans, capital lease obligations, other obligations as well. Managing the long-term debt in
in the capital structure is responsibility of top-level executives, such as the chief financial officer and the CEO of the company, as well as owners of the company. Managers at the field level, such as branch managers, can impact this number by optimally managing assets that are entrusted to them, which will free up cash that can be used to pay down debt. Deferred tax liability typically results from the difference between accounting used for financial reporting and accounting used for tax reporting. One major difference is how depreciation is calculated. For example, the IRS may allow you to take certain types of accelerated depreciation that generally accepted accounting principles do not when you're creating your financials. So even though you haven't had to pay that tax to the IRS or even recognize that you owe it right now, you will ultimately have to pay it when you do your depreciation the other way through your accounting. And so they make you go ahead and recognize that expense in your accounting financials or your financial reporting books, but you don't necessarily owe it to the IRS yet. Stockholders' equity represents the book value of the owner's portion of the company. Stock at par or stock at par value. This is the stated value of the shares that are issued. The actual market value, i.e. what they're selling for, may be more or less than the stated value. Here the stated value is $100 per share. The shares could be selling for more or less than $100, but on the books the par value of them is listed at $100. Additional paid in capital is the amount paid for the stock to the company above the stated or par amount. So for example, if the company sold stock for $180, the $100 would go into the stock at par and the $80 would go into additional paid in capital. Retained earnings is the amount of net income that you find on the income statement, amount of net income earned that has not been distributed out to shareholders in the form of dividends and has been retained by the company continue to invest in growth or paying down debt. So if net income goes up on the income statement, the retained earnings will go up on the balance sheet unless it is paid out to the shareholders in the form of dividends. And that is the elements of the balance sheet. And remember that ultimately total assets will always equal total liabilities plus total stockholder equity. And again, remember the reason is it's a basic accounting rule. It has to because that's the rules. Every rule points back to that. But also more importantly from an operator standpoint is that all assets of an entity are funded with either a liability or equity or some combination. And that concludes our video on the introduction to balance sheets.